materiality. And then under the reliability, we have almost about 3 or 4, I think 5 of these. We have what we call faithful representation. We also have what we called, we also have what we call substance over form. Then we have, lastly, we have what we call prudence, saying that financial statement supposed to what? Have the nature of what? Prudence. We'll talk about all these things going forward. So when it comes to the features or the characteristics of the financials, the qualitative characteristics of the financial statement or the accounting information, here we have the fundamental, we have the enhancing. Under the fundamental, we have the relevance, we have the reliability. Under the relevance, we have materiality. When it comes to the reliability, we have what? Faithful representation, we have substance over form, and we have what? The prudence, what? Feature. When it comes to the enhancing too, we have 4 under that. We have understandability, we have the timeliness, we have the verifiability, and we have what? The comparability. We are going to walk ourselves through with these what features of the financial statement going forward. So let's start with what the fundamental. So under the fundamental, as we said, we have what the relevance. When we say accounting information should have, or the financial statement should have a feature of relevance, it's pretty simple. When we say relevance, relevance has to do with, okay, if information is relevant, this is what we mean. It means that the information is supposed to be able to influence the decision that users will make as per the financial statement. If financial statement has a nature of relevance or a feature of relevance, then it means that the information presented in financial statement, if it is relevant, then it means that users' decisions should be able to be influenced by the financial statement. So information is relevant if it can influence decision made by the users of what? The accounting information, in order to help them to evaluate the past, the present, and the future, even to make what corrections in the previous what? Financial statement. So relevance means that the information or decision that these users make, it should be able to have the ability to influence those decisions. So that is the nature of relevance. So if something is relevant, it means that it can influence the decision you're going to make going forward, right? For instance, the decision of your parent concerning your education, it can be relevant, right? Even though you may have your own decision of, let's say, you want to do this particular course, you want to read this particular course, but your parents will say, hey, I'm the one that's going to pay your school fees. I'm the one going to do this, buy the textbook, pay your accommodation fee, your feeding fee here and there. So go and do this course. So that means that here, your parents' decision is key, it's relevant. It can influence the decision you're going to make at the end of the day. That determines the nature of what? The financial statement having the information of being what? Relevant. That means that in terms of users of the accounting information, the decision that they're going to make based on the relevance of the information can influence what? Their decision, right? So here your parent decision can be what? Can have a great impact in the decision that you're going to make as per the course you're going to read at the university or the institution you find yourself. So we can say that your parent decision is what? Material. It's material because their decision as per the course you're going to read at the university can have the influence on the decision you're going to make as per the course you want to do it for yourself. That is what? Materiality. So when we say materiality and the relevance, it has to do with if something is material, then we are saying that its omission or misstatement can tend to affect the decision that's going to be made by the users of what? The accounting information. So if something is material in the financial statement and it turns out that it can affect or influence the decision that's going to be made by users, then it must be stated or it must be what? Disclosed in the financial statement. So once that means that once you omit it, then it turns out also to affect the decision that users will make. For instance, let me give you a classical example. Let's say we have 2 firms. We have firm A and B. We have firm A, we have firm A, and we have what? Firm 1B. And firm A declared a profit for the year. Let's say the profit for the year, firm A declared a profit of $6,000, okay? And firm B declared a profit of what? $2,000 dollars. All things being equal, we have held other factors what constant. All things being equal. If you are an investor in these two companies, which of the companies are you going to invest? Isn't company A? Yes, it's company A. But how do you get to know that they made a profit of 6,000? It can be even that it is what? A creative accounting that they have done here. When we say creative accounting, this is where accountant fabricates what? Figures in a financial statement to present a good picture of the financial statement so that it can influence investors to come and invest in the business. For we they know it's a fraud. So that means that these profit figures is material. They are material in a sense that it can influence the decision that investor will make when it comes to the financial statement. So that's why we are saying that if an information is material and can affect the decision that users will make, it's supposed to be disclosed in the financial statement. So if you omit it or you don't or you misstate it, you're supposed to be less than 6,000, but you would let's say 4,000. That means it can affect the decision that user is going to make. So materiality means that if something is material, its omission or misstatement can tend to affect what? Decision that will be made by the users of the accounting information. And this is what we expect the financial statement to have. Supposed to be relevant. Looking at 6,000, 2,000, you want to invest in 6,000, but the 6,000 can be a creative accounting, fabrication of figures. And you will be influenced to come and what? Invest. And later on, you find out that it was creative accounting, where they have manipulated figures to present a nice picture of the financial statement of the company. You will turn out to lose. The issue about men's gold, why people want to invest. You see what happened? You see what happened? It closes and then people were losing. It was what? A creative accounting. They presented a nice what? Financial statement. And then people turned out to what? Invest. Later on, they realized there was a creative accounting. Men's good for you, right? Those in Ghana here, you can understand some of these issues that I'm talking about. So that means that when you are presenting information, if it is material that it can affect or influence the decision of users, you need to what? State it. But if it is immaterial and cannot affect the decision that will be made by users of account, you can disclose it as part of the note to the account. So that is the issue about relevance when it comes to the fundamental. Faithful representation or reliability. And the reliability, if something is reliable, that means that we can depend on that information. So something to be reliable means that it's supposed to be accurate in the first place. Accuracy is key. So once it's accurate, that means we can depend on such information. And that's why we expect the financial statement to be what? Be supposed to be reliable, supposed to be accurate, so that users of accounting we can depend on it. So that means that if you want to depend on it, that means that the information in the financial statement supposed to be faithfully what? Present. So faithful representation. When we say faithful representation, it means that the financial information, all right, or the financial statement must present, right, the economic phenomenon that it purports to what? Represent, that it purports to represent. You have the word purport. Purport to what? To represent. Think, let me check. Yeah, it purports to what? Represent. So all the economic phenomena of the transaction must be what? Represented in the financial statement. That is faithful representation. Right? So we must present the economic phenomenon that it must be included in a financial statement. So for a presentation, for a financial statement to be faithfully represented, that means that it's supposed to have three things. Faithful representation. Supposed to have three things. Let me bring you here. One, it's supposed to be what? Supposed to be, neutral. Supposed to be neutral. That means what? Is free from what? Biases. Free from biases. Two, it's supposed to be complete. Supposed to be what? Complete. Complete means that we don't leave out any vital information that will make the information what? Incomplete. So all the necessary information must be captured. Faithful representation. Then three is supposed to be what again? What again? It's supposed to be what? Free from what? Material errors. Free from material errors. Free from material errors. So you're supposed to be free from what? Material errors. So this is what we call faithful representation. The financial statement must represent the economic phenomenon of the transaction it purports to represent. And for a transaction or for a financial statement to be faithfully represented, it's supposed to be neutral, free from biases, complete, We do not lack any vital information that will make what the transaction or the financial statement incomplete. And then also it should be free from material error. It should be free from material error. This is what we call faithful representation under the fundamental or under the reliability as one of the key financial qualitative characteristics of the financial statement. We also have substance over form. Substance over form. It's also an aspect of what faithful represent. When we say substance over form in accounting, very simple. Let me give you an example. Let's say you run a business, you run, let's say, a transport business, travel and tour, a transport business. And for a particular occasion, let's say it was Christmas, where people need vehicles to convey their goods, convey a lot of things from one place to another. And let's say you used to have what? 50 buses that do this, movement for goods and what people from one place to another. And because of that occasion, you required additional 5 buses in order to top it up for you to what achieve the goal of what, moving goods and people from one place to another. Right? And then you decide that your friend in another business has excess buses that you can what use. And then your friend decided to, borrow you what the 5 buses. But here you are paying for something. So let's say that the cost of these 5 buses was what? Let's say it was $100,000. $100,000. This is the cost of these 5 buses that you hide. So I think the right word is hide. You hide from your friend in this same what business. To add it up to your 50 to make it 55 so that you can run the business. This was the cost of it, but you paid for the hiring, you paid for the 5 buses, you paid for let's say you paid for it was let's say for about a month, you paid for let's say $10,000 for the month. What is happening here? Substance over form. Substance over form is saying that hey, when it comes to these two figures, which figures are you going to represent? Are you going to what? Incorporate into the financial statement? Or are you going to record into the financial? Are you going to record the cost, the initial cost of the bus, which is what 100,000, or are you going to represent what the 10,000 which you have hid? So substance over form is saying that hey, when it comes to recording of transaction, you are going to record transaction that gives the economic value, of the transaction, rather than its word original cost or the legal word form. So when it comes to recording this in the financial statement, in the books of what, let's say, Mr. A who hide from what Mr. B, Mr. A is going to record what this 10,000 in the financial statement rather than what this 100,000. Why? Even though we know legally the bus belongs to what Mr. B, but for business purposes, resulting in transfer of what money, economic value, then it means that for Mr. A to record this in his books, they are going to record the value of the asset that is going to use for a period of time, which is 1 month. That value that he paid for is that what he's going to record in the financial statement. And this is the thing that I'm going to record. This is what we call substance over form. This is why we record the economic phenomenon of the transaction in the financial statement rather than its legal form. Substance over form. This is why we record the economic what? Transaction of the item rather than its legal form in the financial statement. This is what we call substance over form. So here we know that legally the basis belongs to Mr. B, but economically it belongs to A. And for A to record this in his book, he's supposed to record what? The 10,000 that he hide the assets to assist in his business of for travel and tour because of the occasion. This is what we call substance over form. So here, that means if you recorded this, you have been faithful what to represent. There's no any material what error. But if you rather recorded this, that's where you are not faithful what represent. Substance over form. And prudence is also another aspect when it comes to the fundamental issue. So prudence. Prudence means that here caution is exercised in a degree of estimation of profit, right? So here we exercise, there is a caution that is being placed on the degree of how you estimate transactions. So here prudence is saying that in accounting, you're supposed to estimate the future losses that may occur but you don't estimate what future profits. So you estimate what future losses, but we don't estimate what future profit. Why? Because for sure, when it comes to business, there are risks. We know that risk is possible. So for that one, we can estimate the risk of that losses. We can make that estimation and make provisions for that. Provisions for that. But you can't tell me that in the next year you're going to make a profit of what 20,000. So you have made that provision 20,000 there. So if you don't make it, come and substitute. No, that's not the right accounting. So the right accounting has to do with, because you know that business we are bound to make what risk losses. So that one we can estimate or make provision for those losses rather than the profits. And here it results in prudence. So that means that once you make estimation of losses, then it means that you have faithfully represent the information in the financial statement. This is what we call prudence. Faithful representation then substance over form. Under fundamental. When it comes to the enhancing, as I said, these are the supporting. They are there to improve the fundamental, right? So, under the enhancing, we have four features or qualitative characteristics that comes under the enhancing. We have understanding. What is understandability? When we say understandability, we are saying that the financial statement that we present is supposed to be what? Clear and concise, free from any inaccuracies, and put it that way. So you're supposed to be what? Clear and concise and simple to what? Understand. It's supposed to be clear, concise, and simple to what? Understand. This is what we call understandability. And under the qualitative characteristics of the accounting information or the financial statement, so that users can easily understand it and make what useful decisions with it. The next one has to do with what? Timeliness. Timeliness. When we say timeliness, we are saying that the financial statement or the accounting information is supposed to be present on time in order to make what? Useful decisions. If it's not present on time, that means that we can't make useful decisions with it. It needs to present on time so that decision makers can make useful decisions with it, unless it makes it what? Irrelevant. It makes it irrelevant. So presentation of the financial statement for useful decisions should be on time so that it reduces its lack of what irrelevant that makes with it. So that is timeliness when it comes to the features of accounting information. Then we have verifiability. When we say verifiability, here knowledgeable, independent, and observers can reach a consensus, right? Can reach a consensus over the same results over a period of what time. So let me give a classical example. Let's say we have accountant A at Accra, and we have accountant B in Kumasi. Accountants A and B are co-workers in LP Company Limited. LP Company Limited. That means that if A is getting a result of, let's say XXX, that means that B is supposed to get the same result of what? XX, because they are coming from the same one company. So when it comes to creation of financial statement, if you are using any method to arrive at any values, it's supposed to have the same effect. So the one in Kumasi, the one in Accra is supposed to have the same result as the one in what? Kumasi. This is what we call verifiability. Why we have what? Why we have different knowledgeable and independent observers can reach a consensus that the information is faithfully represent the economic what? Event that is purport to what? Represent. That's what we call verifiability. So if A is getting SS, B is supposed to get SS. The same word consensus, the same word results. This is what we call verifiability. And then lastly, comparability. This is where the financial statement will have an element of being, or should have a feature of being able to compare across companies or across what firms, and with what? Time to what? Time. So you should be able to compare company A against company B within the same what? Industry, or you're supposed to be able to compare the financial statement of a particular year to another year, or let's say from the current year to the previous year, or from the current year to the future one is going to provide. Because remember, when it comes to accounting information, they are all historical information. We'll get to some of these when we start with the conceptual framework of accounting. All accounting information or financial statement, they are produced historically. That means they are previous information that based on that we make useful decisions with it. And these are the things that we look out for when it comes to the features or the qualitative characteristics of the accounting information. And this is where we bring our part two of our discussion on introduction to accounting. So I'll see you in the next session where we discuss the financial statement.